Hey, Steve. Thanks for coming on the podcast today. It's great to have you.
No, thanks for having me on, Nick. Really looking forward to this.
Yeah, I'm really excited to get a bit more of a deep dive into commercial property because we see you talking about it quite a bit, and we see quite a bit of that now. The inquiry is definitely up there. So yeah, really keen to jump in and learn a bit more.
Yeah, no, it's good. And you of all people know the benefits of commercial. Like we've worked together on a few deals now, so it's all kind of come along. But there's a lot of pros and cons, and a lot of misconceptions as well.
Yeah, 100%. So before we jump into commercial property, would you like to tell the listeners a little bit more about yourself, where you come from, and what brought you into the kind of property buying game?
Yeah, so I'm a bit of a long-winded one. So I originally was really good at maths. I got like fifth in the state and foreign at mathematics, and did really well. Got like 99.5 in high school, and then went and studied engineering. Just because I was like, I'm good at maths, I'm gonna have to do something to do with maths. Did engineering, so I did robotics and mechanical engineering at university. Then when I got out of university, I did like medical engineering, so I designed like defibrillators and robotic limbs and some cool stuff like that. But what I didn't like about that is you're literally sitting at a computer all day, every day, just typing code. So even though it was a cool job in quotation marks, it was just like a graft all day. And I'm a little bit too social for that. And I kind of like travel too much to be locked to a desk. And then sold out a little bit, went and worked in mining. So I went and started designing mine sites for a living because it paid about twice as much. And then on the side scene, there was like a guy from school who became a buyer's agent and a couple of those young gurus back in the day that had like 20 plus portfolios. And I'm kind of sitting there as an engineer on like 70 grand, 80 grand a year at the time as an intern. Like, why am I working my bum off when these guys are making lots of money doing something that's quite simple? And then I lived in Western Sydney, bought my first house there in Blacktown for 230 grand. And then that went up about, I think it was about 100 grand in about a year.
Yeah,
And then
right.
I was just like, okay, this is like 5 years worth of savings, and I've done it from signing a piece of paper and like I did a little reno, paint and carpet, stuff like that. Like there's something to this. And then ADD Steve came out, read every single book, listened to every single podcast, and then was
Yeah.
slowly accumulating my portfolio in the background. So I think I had 5 or 6 properties at the time. And I was sort of getting known even in my workplace as the property guy. Like the CEO would come sit in my office for an hour every week and chat property. And then I was like, look, I might as well do this full time. So I became a buyer's agent. And now we're 1,500 acquisitions later, 2 books in stores, got my own podcast series and stuff. So a bit of a unplanned career change slash now it's complete livelihood.
Yeah, that's fantastic. And what's the name of your podcast too, so our listeners can have a listen?
Commercial property investing explained. I'm very boring ex-engineer. Everything's this needs to be. Even my books are called Commercial Property Investing Explained. It's just simple. It's like a no nonsense. Like the first 10 episodes is like everything you need to know. We'll try to cover it on this episode, like a bit of summary.
Yeah,
But if you want a bit of a deep dive, if you want to know 50 minutes on what you need to check when you look at a lease, go to the lease episode and we talk about it for an hour.
yeah, that's fantastic. And it's funny, I actually have one on my desk. I just
Hey,
forgot.
there we go. I've got one too. Look at
Sure.
us.
Matching. How great's that? No, I
Also
had
got a resi one.
I actually just lent that out yesterday. I have
Oh,
a
cool.
customer who's looking at property, and very first time, and yeah, part of the education piece was, hey, have a read of this book. I think you really like it. So, no, that's great. That's great. No, I suppose a lot comes across from the engineering background in terms of the numbers and getting things to fit when looking at commercial property and acquisition. So that makes a lot of sense. That
Yeah.
transition.
Yeah,
Yeah,
it wasn't a conscious transition though. So I was originally the like everyone else, a resi person. Like I'd bought like 800 residentials for clients, and I sort of fell into commercial as well because I was still doing residential based on the numbers, but had a couple high net worth clients come and say, "Oh, can you buy me a commercial?" And I, like everyone else, I was just like, "Why would you bother? Too high risk. You're going to sit there vacant. They don't grow the same. Too much of a deposit needed. Like, what are you doing? Like, just stick with residential." And then they kind of pushed a little bit. And then as I started looking at them, I actually was like, "This can't be true. Like, this is literally too good to be true." Like back
yeah,
7 years ago, you were buying 8 to 12% net yielding commercials, net. So like that's not
mhm,
included, like the tenant pays the outgoing, stuff like that. And you're getting like a 4% interest rate. So you go buy
yeah,
like $1 million commercial and you're talking like $40,000 a year positive cash flow. And I was just like, this, I'm missing something here. This can't be this attractive. And then bought one, bought two, bought 10. Now we're another like 700 down the track. And yep, the concept's still proving true.
Yeah, that's fantastic. And when it comes to commercial property, is that one of the aspects that obviously drew you to it was the net yield? Is there anything else that stands out with commercial that you really like?
There's probably more value add. So if you do want to be an
Okay.
active investor, you've still got all that you can do with residential. So the standard subdivisions, redevelop, renovate if it's like a retail or something. You've still got that, but then you've got more creative stuff like you can split tenancies up. You've got a warehouse, turn a single freestanding warehouse into 4 tenants, and that actually increases the capital value because you get more rent for a smaller tenancy than you do a big one. You can do solar panels on the roof. We did one in Perth recently. We bought a freestanding building, and we've got a Vodafone contract for $1 million for 10-year lease for the roof space. So they put
Oh, wow.
telecoms on top. So you've got that as well. You've got fabrication of the rent, even changing the quality of the tenant can change the price. So
Mhm.
there's way more kind of moving parts that you can actually massage to get it a really good outcome. But the main thing I like about it is there's no emotions. Resi,
Yes.
there's like tenants got lots of rights.
Mhm.
Commercial, they've got rights, but it's pretty much a contract between you and them, and you can write anything. Like there's a retail leasing act with some things, but if they don't live up to their contract with you, i.e. the lease, you can kick them out, put the new tenant in. So there's no emotion in that at all. It's all based on the numbers.
Yeah, very much business to business, which I think is good
Yeah.
because with property investing, I think that's what kills it for a lot of people is if they get too emotional, they can overlook the numbers and it just doesn't fit. Where when
Mhm.
it's commercial, and you see it working with the customers, is everyone's a lot more numbers driven. How does it fit? How fast can we pay it off? What's the best structure? And it very much comes down to that, which is good. So, when you are going into a property and you're looking to do some value add, let's say we're buying an industrial warehouse, obviously dividing that's one thing. Another thing that gets thrown around mezzanines
Mhm.
to increase net lettable area. Is that something that's relatively easy to do to kind of boost that value?
Yeah, exactly right. So like that's probably the most common one in industrial. So for those who like listening, it's basically you build another story in the warehouse, like a lighter industry story. So you literally because you rent out per square meter, you get more square meters. So if you increase the net lettable area by 20%, value effectively is 20% more. It's not exactly that. It's more like 15% because like you won't rent a mezzanine out the same as like a hard stand floor, for instance. But you've just fabricated it from doing something quite cheap, like a standard kind of mezzanine is about $80,000. You'll knock one up. So on $1 million purchase to make 150, 200 grand, it's not a bad return on investment for that. So that's a good option there. Mezzanine can also be an office space. So if you want more a mix of an office in a warehouse, you can do that. And you can also do this with residential, so retail as well. So like at the moment, I own a cafe in Brisbane at the moment. I can build
Mhm.
on top of that up to 12 stories. So I'm most likely looking at doing like a residential on top. So we've still got the
Mhm.
residential aspect to it as well.
Yeah, that's fantastic. Bit of mixed use, which is awesome. Because with the value add,
People always want their like, oh, I love mixed use, multi tenancy, and things like that. But you can buy a vanilla commercial. Like my best performing personal like purchases are
Mhm.
very stock standard, good tenant, good location, good infrastructure spending nearby, good population growth, and a versatile premises with one tenant. And
Mhm.
they're doubled in value in the last kind of 5, 6 years, and I've done nothing. So similar to like my Blacktown house one, if you get the
Yeah.
fundamentals right, you can have a
Mhm.
good outcome. That's also what I like about commercial is because there's no emotions involved, I can actually predict the market a little bit more than I can residential because you touched on this
Mhm.
with residential, how it's an emotional game. That's
Yes.
part of it where most investors really struggle because you can have all the numbers in the world on paper, like, oh, vacancy
Mhm.
rates are really tight, like there's short days on market, look, there's 20 applicants per property, et cetera, et cetera. But the emotion side is the one that kills it because if you've got people that really want to buy there more than somewhere else because it's a nice area or there's beachfront or it's a good community, that can push prices up 10, 20%. And that's an intangible number. Like you try to translate it to some numbers, but ultimately it's like I live on the northern beaches of Sydney, and in terms of investment, it's the worst place to buy because if instead of buying a $5 million house, I buy a $5 million commercial. $5 million house is going to be like 300 grand negative for mortgage
Mhm.
repayments. A $5 million industrial property is going to be 100 grand a year positive. So I'm 400 grand difference from buying the commercial. But emotionally, I want to buy a house and live here. So that's taken over all the rational brain.
Yeah. Oh, very, very much so, very much so. And just touching on that with the negative cash flow and the potential positive in commercial, I find running the numbers, especially from a servicing perspective as well, is with commercial property, because the net yields are so high, even though the interest rates are still high, it doesn't take long for that to become a cash flow positive property. Because I think a lot of people, they see, oh, it's a higher interest rate, it might be higher vacancy. But we ran some numbers the other day, and I looked at it. We factored in very high vacancy and all of that, and it still paid itself off well before the 30-year loan term, which is amazing. So when you're looking at a property, especially in the commercial space, do you help customers with their numbers just so they can see how kind of that acquisition and property strategy plan is probably a good way to put it?
Yeah. So normally the first step is I introduce them to someone like you, which I've obviously done many
Yep.
times. And then you'll assess it, and then you'll come back with their capacity. And then I can actually show them some sample properties being like, this is what it looks like in regards to your cash flow. And I don't just do it off today's interest rate. I do it off yesterday's one, and 10 years time, I do the full spectrum of like 0 to
Mm.
12% interest rates, because a lot of people really worry about like, oh, I don't want to buy now. Interest rates are too high. You weren't saying that 3 years ago. So that just means you
Yes.
didn't plan well 3 years ago. You should be saying, can I afford this over 10 years? And you're going to see the full sinusoidal wave of interest rates. So plan for that. So I give them a good snapshot of what it looks like. But like you said, like most of the stuff we look at, like within 15 years, you can have it paid off if the market works really well. You're doing what you should do and really stress testing. So you're probably taking the worst of the worst. Whereas if you're
Yes.
actually taking things like at the moment, like with inflation, rents are going up like 7 to 10% year on year. And that won't last forever. That only might last a couple of years. And then interest rates might come down. Then you might get some more value out of the property, for instance, and it's going to have capital growth. So you can pay it off really, really quickly, which is the main advantage. And that's mainly what I like. And that's why I like it. Think it's lower risk than residential. Residential, you have to wait the 20, 30 years. Commercial,
Yeah.
you can knock it off a bit quicker. And you touched on a good point about like, oh, even if we take in high counts of vacancy, you don't have to buy a high vacancy rate commercial. Like
Mm.
industrial at the moment in every capital city, it's sub 0.6% vacancy rates. Sub zero point 0.6.
Yeah.
So some of the areas I buy in, it's a
Mhm.
0% vacancy rate. There's nothing available and there's a waiting list. So a lot of the resi people go, oh yeah, but are you going to sit there vacant for a long time? No, you're not. You're wrong. That's just because if you don't know what you're doing. Even if it was, let's use an example. So like let's say $1 million residential, we'll keep the numbers simple. $1 million
Mhm.
residential, $1 million commercial. The $1 million commercial will be, let's just say, even if interest rates are high and they've got a high LVR on it, 10 grand a year positive. Whereas
Mhm.
the residential $1 million probably around 20 grand negative for
Negative.
that's a decent yielding one.
Yes,
So if
correct.
I get something with a 5 year lease and it's 10 grand positive, in 5 years' time, I'm up $50,000 in my bank account. The
Yes.
residential, they're down $100,000.
Mhm.
So how long with the difference in that value? So if there's 150 grand disparity there, could that property be vacant for before I actually have to start dipping in my own pocket? And you'll actually find like even on like I don't know, say 7% interest rate and it's 100% loan, it's 2 years. 2 years
Yes.
you've got before you even have to dip into your own pocket relative to the residential. So when you look at it like that, you go, okay, it's not a lot higher risk in regards to that. It's high risk in regards to you need to have a bigger buffer because it's going to go from like residential is always going to have the tenant, but commercial, it comes in one big go. So you need to plan for those.
Yeah, and that makes perfect sense. And I, it's funny. We looked at one yesterday. It was an SMSF purchase. We were looking at the commercial, and it's true. When we look at it, we do stress test it quite a bit more for the lending purposes.
Mhm.
And we were showing the customer, look, based on your current contributions, you can borrow this. And he was saying, well, I thought it was going to be cash flow positive. Like, why these contributions? And when we flipped it over and we looked at actual interest rates without the buffers in there, but still with a good vacancy rate in there just to
Mhm.
be super safe, it was only $1,000 negative per year, whereas the lender needed 20 of income. So it's funny when you actually look at the numbers and you pull it out and you do your cash flow. Yeah, they're almost positive from the get go, if not they are. And as that cash builds in that offset, the monthly payment could be going down if we're on interest only, building cash faster, we're paying it off quicker, or potentially building a buffer to buy another property. So it's really good, I think, for commercial if people are looking to buy multiple properties in a shorter
Mhm.
time frame than resi. Because if we're buying one, value add, cash out, buy the next one, we can kind of continue that spiral, which is good. So, do you have many people that buy one commercial, then start upgrading and just continue building that portfolio?
Yeah, most of my, like I've got to say, probably 30% of my clients buy kind of two or three properties as a minimum, but it just depends on what you're trying to achieve. Like, you touched
100%.
on like self-managed super fund ones. They're an interesting one because the interest rates are higher, so the cash flow is not really there. But what you
Yes.
need to point out to people, there's a few options, and I don't want to give financial advice, but like obviously if you do extra contributions, there's huge tax savings there. So if you're going to put in an extra 30 grand a year, for instance, for the next 5 years, that LVR is way lower. So it started to 70% and now it gets down to like a 50%. That then becomes cash flow positive. But the other thing you need to point out is you're also leveraging. So say you have a 70% LVR, in 10 years' time, if that property doubles, you've
Mhm.
made like quite a lot of money. Whereas if you just put that in like a share fund, it'll be positive because there's no debt to it, but it'll be like a 7% return on investment. This becomes a 20% return on investment in 10 years' time. So it's an exponential. So it's a bit more of a delayed gratification type one. Um, but in regards to like the type of stuff we kind of look for clients, it's matching up with what they're trying to achieve. Some clients are mum, dad client. They just want a nice little 25 grand passive income in the next kind of 5 years because they're going to go on maternity leave or whatever it may be. Other ones are the young, really ruthless ones that want to have the big portfolio like myself, and which is fine. That's there. Then there's the low risk ones. I get a lot of older clients, like 60-year-olds that want to retire in 5 years' time. It's about buying them a bulletproof commercial because they're using like a lot of cash or selling a residential. That's about getting something that's not going to have vacancy. So we get like a multi-tenancy or you buy multiple ones. So it just depends on what they're trying to achieve over
Mhm.
what time frame versus what they've got to work with. And what I mean by that is the finance side. So how much can they actually borrow, because that can sometimes have a play, as you mentioned. Like sometimes commercial like lending, you've actually got more options and bigger borrowing capacity. If you're
Yes.
starting out, sometimes it's the other way around. Like if you've got access to 90% loans and lenders mortgage insurance and serviceability is an issue, go out and buy the three residentials versus the one commercial, because if we get the same capital growth, you make three times as much.
100%. And something that's changing, I think, at the moment, lenders are really opening their policy to commercial property investors. Like one recently, I've had three customers now that we've sent off to a particular lender who, for self employed, is now doing up to 100% LVR
Mm-hmm.
on commercial, which is great because it means that it's removing some of those barriers. And in this particular customer's instance, it means they don't have to use all the cash in the business to buy their premises. They can essentially buy, invest, and continue running and continue doing what they need to do. So I think it's good. And with the servicing aspect of it, there are a lot of options with lease doc loans, full doc loans, and different ways that different banks calculate it. So we were doing the numbers the other week. We spoke to all of the different banks and put it into a spreadsheet, and you can key in the loan amount, what the rent is, and it's interesting to see what each of the lenders will lend because the majority of them are different, and some of them are different
Mm-hmm.
by 100, 150,000 for the
Yeah.
same property, or because different appetite for commercial at the moment. So I think that's really interesting. But when structured the right way, I think the different lending products that we have can certainly boost a portfolio, or they could be something to restrict it. But I think as interest rates kind of come back down, I think we're going to see a big uptake in lease doc lending because at the
Mm-hmm.
moment, a lot of it's full doc or a lot of it's we can set it up in a way where we can recycle the borrowing capacity with trust
Yep.
lending and putting them in special purpose vehicles. But essentially, as interest rates come back down, I think lease stock is really going to be on the up and up. And I think a lot more people will be buying. So, for those that don't know, lease stock is when you purchase a commercial property and the rental income from the property can service the interest on the loan, generally at a 1.5 times multiplier of actual rates or rates plus 1%. So yeah, it's going to be interesting when that does occur and that new, I wouldn't call it new, but maybe revived line of funding comes into the market, whether that's going to drive up commercial prices. Because if rates come down, and that then may ignite a fire in the commercial market. Because at the moment, I know you cover all of Australia. Is that right for commercial
Yep, that's
purposes?
right. Yeah, I've bought in every capital city, every regional town.
Yeah, fantastic. And I suppose at the moment, correct me if I'm wrong, there's some towns that are doing really well, and then you've got obviously some capital cities that aren't doing as well. What are some of the trends you look for when you're trying to select one of those areas in a commercial property? Is there any particular trends or indicators or anything that you look out for?
Yeah, so you've got the same premise as residential. So you still look at all the big macro data. So
Mhm.
like what's the population growth? But property growth comes from supply and demand, especially
Yeah.
with commercial. Like obviously if there's more demand than the supply, that's what pushes up prices typically.
Mhm.
So obviously vacancy rates are the big one. We want to have really tight vacancy rates and even in
Mhm.
tightening the vacancy rate. So we look at the trend. So if the trend's going down, and we can prove that that commercial is going to have more demand in 10 years' time than it is now, then that's probably a good buy. No one can predict the market to 1 or 2 years because there's some external factors with the economy, unemployment, interest rates, and things like that. But like the way I'll break it down for like the listeners is like, say I buy an industrial complex, so like a warehouse in an industrial complex, and it's completely surrounded by residential and that residential population, I look at the census data and I look at the council websites, and I find that population's set to grow by 50% in the next 15 years. Why would the industrial be in less demand than it is now when the vacancy's already tight? And if they're building infrastructure, they're going to need obviously like the machineries, the fabricators, the storage, etc. Then you've got to service the local population as well. So you need car mechanics, wholesalers, distributors, fabricators, all that type of stuff. And then if they're changing the zoning of the residential, and that's going to kind of like medium and high density to help with the population growth, that's more people that need that service. So I won't guarantee capital growth for someone, but I'll guarantee with the properties I buy, there'll be more demand for them. And then that kind of
Mhm.
translates. But to answer your question with some of the fundamentals, vacancy rates,
Mhm.
versatility, days on market, obviously the strength of the economy, strength of the type of investment as well. And I'll be very careful when I have these podcasts is when I
Mhm.
say commercial, you can't take it as every single commercial. Office
Yes.
space, for instance, is not performing as well as industrial. But that's
Mhm.
because office space, COVID kind of killed it a little bit, and you're paying for a bit of concrete in the sky, whereas an industrial space is land. So it's got the land capital growth as well. Retail, completely different kettle of fish, all to do with foot traffic and the kind of like environment that it's in. So, like, what I mean by that is a retail one street back from the beach is not comparable to the beachfront because the beachfront has, I don't know, 10,000% more foot traffic than the one street back. So it's got different vacancy rates. So therefore, it should have a different yield to reflect it.
Mhm.
But normally, when you look at the big data, you're considering office space and industrial. Retail, it's
Mhm.
more lifestyle, foot traffic, and then you'll still look at the population growth there. So I know I rambled a little bit, but hopefully I threw some of the reasons why they kind of grow in.
Yeah, that's great. And touching on, you mentioned different types of commercial property. Are there some types of commercial property that are a little bit more aligned with the beginner? Because I know you mentioned you look at their goals and objectives as one of the main drivers.
Mhm.
But probably rephrase that. Are there any commercial properties that you advise to steer away from if it's your first commercial property purchase?
Yeah, generally office space, just
Mhm.
because it is the highest risk one at the moment. So like they're the ones with like most capital cities have about 12 to 15% vacancy rate. So a lot of people kind of get kind of persuaded into it because they'll go, oh, look, I get a 7.5% net yield for this office space and it's got a 3 year tenant. That's great if your tenant stays on for the rest of your life. But if the tenant leaves in 3 years' time and it's vacant for 2 years, that's not a great outcome. So I'll generally say industrial and retail. Industrial, if you want to make the number purely based on decisions, because it's just purely based on numbers, because you can look at square meter rates like in the industrial complex, what they sell for per square meter, find the ones that went vacant, how long they were vacant for, and you can get a really good grasp because it is essentially just like three concrete tilt-up panels and a roller door. It almost is a 95% numbers based decision. There's a bit more to do with that because you've got to look at like town planning and cross check everything. But that's probably the easiest to get your head around. Or suburban retail if you know the area well, or using a buyer's agent, for instance, because like those ones you have a slightly bigger vacancy rate, but you get longer periods of tenancy. So if you go out and buy let's just say a medical center on a really good busy strip and they're not building any more commercial retail strips, that will keep a tenant for 10, 15, 20 years, but the vacancy will be kind of 1 year, 2 years. But if you know the area and understand the foot traffic, the demographics, know what's going on in the area, retail's a really good one as well. But again, it's just balancing your risk versus reward. If you've got the money, buy different ones in different industries. Buy a couple industrial, a couple retail ones, a medical, and diversify the locations, the types of assets, and have a really low risk portfolio.
Yeah, it makes perfect sense, and I think diversification is key when it comes to some of this property investing, and I think that's what commercial helps with because you
Yep.
have the cash flow and you can buy multiple properties, you can spread that risk, and buying interstate or even just a little bit away from each other using a service like what you offer, having that knowledge and the foot on the ground, I suppose it helps diversify a little bit further as well, which is fantastic. And as for the more advanced properties, do you ever look at childcare centres and supermarkets and stuff like that? Is that on the radar as well?
I'll touch on a quick point. So you said about diversification. Don't forget, a lot of my clients come to me from residential because they want to diversify into commercial. So there's another layer there which you can look at as well. And
Mm.
also diversification in regards to protection of the cash flow, because obviously you're getting negatively geared with interest rates at the moment with residential. Commercial will obviously keep their cash flow. And I'm weirdly, from a business perspective, every time I see interest rates rise, in my head I always go, oh no, that's going to bring bad sentiment to the market and the price is going to go down and I'm going to lose clients. I get more clients every time interest rates go up. I'm busier than I've ever been because people start looking at residential returns going, this is ridiculous. And people still want to buy. Australians love property. Like they want to put their money somewhere. They then look at commercial and go, oh, this is brilliant. Let's buy that. But going back to your question, so what was it? It was, I forgot what the question was.
Supermarkets,
Supermarkets.
yes,
Um,
childcare centres.
Yep. So we buy a lot of supermarkets. So we just actually bought an entire supermarket with, was it? I think it was about 14 tenants in Perth
Yeah,
for eight and a
right.
half mil. We got that with like 7% yield. You can buy little cheaper ones in more regional areas. Childcare is a bit of a funny one. So there's a bit of a misconception about that. People think because it's childcare, it's really low risk because they're like, well, everyone's going back to work or they need childcare. I can tell you
Yeah.
when I actually research a lot of the childcares are struggling because of the ratios they need for carers to that and the new working from home culture. They're actually not as good as doing. But then the real thing that stops me buying many, I've bought probably 5 of them in the last 5 years. So I'm no expert, but the biggest thing for me is the yields are terrible. Like because they're in such demand, because people like medical and childcare, the yields
Yes.
are 3-4%. Whereas I would much rather go buy a really quality warehouse on 6.5%, because for that one to perform just as well, it has to grow by 50% just to remain on par. So they seem good that they're low risk, but they're also generally purpose built as well. So if you do lose that childcare, you've got a really weirdly built kind of effectively like an office. It's like a weird residential office that's going to have a long period of vacancy. So they seem good in premise, and I'm not just like putting them down. You have to know what you're doing. There's a lot of moving parts to them. People like them because they get like a 20-year lease, and they go, oh, great, a 20-year lease, and it's 4% that's guaranteed. The guarantees aren't normally that strong. The guarantees are normally back on the business, where if the childcare fails, there's no more guarantee. And that's probably a thing worth talking about as well. With commercial leases, there's guarantees for the lease. So it can be a personal guarantee, a bank
Mhm.
guarantee, or a business guarantee. So you need to check that when you're buying one as well.
Yeah, gotcha. And when it just on guarantees very quickly, do you have a preference towards what the guarantee is? Because obviously, bank guarantee is great; it's cash in the bank. But what are your thoughts?
Yeah, bank guarantee is the best one if there's a hierarchy, but obviously try to get as much as you can. If you can get a bond and a bank guarantee, perfect. Personal guarantees, be very, very mindful of them. You need to check what the person's kind of guaranteeing, because they normally go down with the ship as well. So
Yeah.
unless they've got a big portfolio or something they can put up as collateral, but you try to get as much as you can. I wouldn't use it as a reason not to buy something. I at least want to get a bond as an absolute minimum,
Yes.
because, like I said, you're buying for 10 years. You're not just buying for the next 2 years, or that tenant might leave, and they probably will leave at some point in the next 50 years. So for me, it's all about versatility and
Mhm.
demand, i.e., tight vacancy rates, because that's what's going to give me the capital growth in the tenants long term.
Yeah, makes sense. And just quickly back on childcare centres and that more
Mhm.
specialised type of commercial, it's can be a little bit harder to lend against sometimes because what lenders will look at generally is how easy it is to relet if it was to go vacant, but
Mhm.
also if the property's what we call specialised. And as you would know, but for our listeners, specialised property, childcare centres, abattoirs is a really good example. Cool rooms, lenders don't seem to like cool rooms. Petrol stations is another one.
Car
Um,
wash stations.
car wash, yeah, anything that's really hard to repurpose generally comes with a lower LVR, so you can borrow less against it, so higher barrier to entry. And combine that with the compressed yields you just talked about with the childcare centres at 4%. Yeah, it doesn't really stack up to have to put down more money and less yield.
Yeah. And most people don't realize that as well. Like even
Mm.
like I see a lot of good like really good pubs, for
Mhm.
instance, and they're pretty decent yield, but very one-dimensional property. If that pub goes bust, you can't do anything with it. Like a pub looks like a pub with a big expensive fit out, and you've paid a premium for that. And that's the thing. People have this thing like, oh, it's a great tenant, it won't go anywhere, and they probably won't long term. But if they do, you've just caused yourself a huge financial stress. And banks aren't idiots. They're
Yes.
protecting their money. They're giving you a lot of money. There's a
Yeah.
reason why they want a bigger LVR typically. Same thing with commercial is why you typically need minimum 20, most of the time 30% deposits, because they know it is a bit more high risk. You can mitigate the risk if you've got education or you use a buyer's agent or use like do all the resources and checks. You can mitigate that, but it is high risk long term.
Yeah, 100%. And you're exactly right. A pub's a really good example that I hadn't thought of, because if you're not going to put someone who's hospitality based back into there, it's always going to be a pub. It's always going to have a bar. You probably maybe paid some money to the fit out. And just on the topic of fit outs and whatnot for customers, if we have retail space and the customers put in an expensive fit out, what do you normally see with that? Do you normally have, with most properties you purchase, make good clauses where you want it all ripped out, or are there some instances where you may allow a tenant to leave the fit out there when they vacate? Is there a certain kind of standard there?
No, there's not, because it is so case by case, because it depends how they're fitting it out. If it's something like, I don't know, a warehouse and they're fitting it out like a gym, for instance, and they're like putting mats down and all that stuff, that one you're probably just going to say get rid of it. But like some example are, if I've got a dentist and they're fitting it out with like hand wash stations and a medical fit out and a front desk, that one you'd want them to stay, because you might try to get another medical tenant.
Mhm.
Um, I've got a weirdly, so I've got a cafe and they fitted
Yes.
out with the kitchen and did all that. That was a much harder decision, because when they decided to leave, it's like, do I get them to keep it there and have the kitchen, and then the next person that comes in wants to run a cafe has it there? However, now it's a convenience store, so I actually got it ripped out, but I
Mhm.
had it there at my expense. So I did the weighed risk analysis. It was about 7 grand to get rid of it.
Mhm.
So I left it there, got the tenants, and then when I found someone that said, "Oh no, I want it clipped to a string, stripped to a clean shell," I paid that myself. So this is the fun slash hard part with commercial. It's always a negotiation between you and the tenants. But if you're buying a warehouse, it's pretty simple. Yes, go back to bare bones, because that's what a warehouse is. Office
Mhm.
space, you may get them to leave like the carpet and the paint. However, a lot of people come in and you're part of the value add is paint and carpet it so it's fresh, so you get more tenants more easily. Retail is very hard. Like there's so many parts. One of my other commercials,
Mhm.
um, they renovated. I've got a freestanding building. They renovated the whole of the outside of the building, so added an extra about $100,000 worth of value to my property, and I didn't
Mhm.
pay anything. So that's probably another advantage of commercial. They've added value to mine and asked if it was okay. I'm like, yeah, of course, go nuts. Like as long as it's certified by like tradesmen and things like that. Yep. So they get that part of it as well. So there's a good kind of balance there. At the start of leases, sometimes you'll give an incentive. So I'll give you 2 months free rent so you can fit it out. That's more just to help the business, because it's obviously very hard for a business to pay the rent whilst they're not getting an income from the type of business that they're in. So you kind of help them out there. But then it's also you'll get them for a long lease because of it.
Yeah, and that makes sense. And I've incentives, I suppose, come in all different shapes and sizes. Like I know one of our customers recently rented in Westfields and did a
Mhm.
quite a large fit out, and Westfields actually gave him a decent amount of money to pay for the fit out because it raised the profile of the shopping centre. But in terms of incentives, it is normally, if you are going to give one, is it normally a couple of months of rent up front for free, or what's some of the common incentives you see?
Yeah, 1 to 3 months is normally the standard incentive for retail. That is.
Yeah,
So for
for
office,
retail.
it might be a bit smaller because to put in some partition walls and paint carpets a bit quicker, and then warehouse, not normally anything unless it's a
Mhm,
specialized warehouse. So what I mean
mhm.
for that is like, what's an example? We're under contract at the moment on a pet barn. That's a brand new pet barn, new lease. They've got an incentive because they're fitting it out like a pet barn, like it's all fangle
Yeah.
dangle, paint in the outside and stuff like that before that business. So that one, there's an incentive there. So it's just a balance. But 1 to 3 months is typically the norm.
Yeah, gotcha. And again, case by case, I assume, with the
Yeah, case by
incentives?
case. But retail, I'd say 80% of the time, it's a 1 to 3 month kind of incentive. One thing I want the listeners to note though is don't reduce the rent
Mhm.
instead of that. A lot of people go, oh, well, instead of doing 100% of the rent, let's just do 90% of the rent. So that way my cash flow's fine. The banks value the property based on the rent you're receiving, i.e., the yield. So it's much better to give rent free for a couple months and keep the rent really high. So when you go to revalue the property, they see it at the rent it's supposed to be, not under rented. So that's just a little tip and trick for you.
So internally, and I know this is what attracts customers to your business, is you do quite a bit of due diligence. Obviously, because the commercial valuations
Mhm.
have so many variables, I know that you try to cover off on a lot of those and look at a lot of the due diligence. But you also do a little bit of evaluation internally yourself. Is that right? When looking at a property for a customer?
Not a formal valuation. I've actually got a valuer who works in the team, but it's nothing it's not
Gotcha.
really
Yeah.
worth anything to a bank because it's our internal one.
Right.
It's to make sure we're buying well. And then part of that is if we know what the banks are looking at when they're doing the valuation, we're going to know what's going to stack up nicely for finance as well. So we can kind of look at that aspect of it. But in terms of due diligence, like we give like a 70 to 80 page report to clients on each property. Whereas, like, no offense to residential, once you've chosen your suburb, you check
Yeah.
the flood zones, easements, titles, stuff like that. It's pretty simple. We have to do that for commercial, but we have to do like lease review, contract review, tenant interviews, foot and road traffic analysis, credit history check on the tenant, vacancy studies, occupancy studies, speak with town planners, speak with property managers, speak with the tenant, do a competition analysis for the tenant. Like there's so much to it. But if you
Yeah.
get it right, the numbers are just fantastic. You get like 3 times the rent compared to residential and the same capital growth, and you've got more value add opportunity. So it is a game changer if you get it right. But again, don't want to sugarcoat it. If you don't know what you're doing, you will burn yourself way more than residential because residential, as long as you don't buy in a flood zone or something, it'll tick along like it's supposed to. Every capital city in the last 30 years has quadrupled in value. But commercial, you buy a dud and it sits there vacant for 5 years. Trying to handle a mortgage with no tenant for 5 years is not going to be fun.
Yeah, 100%. No, I've seen the due diligence that your team do as well, and it's very extensive. The amount of documents and whatnot you guys collect, it's quite insane, but it's good. It's good. And I think that's the value that people get buying a commercial property through you versus trying to do it themselves. If they were to engage consultants from different fields to do all of that due diligence work, I actually think it would cost a fair amount more than what it costs to engage you as a buyer's agent to do that work. Because, first of all, they
Yeah.
probably wouldn't know what to check. So they would probably pay some people that they shouldn't. But also, because you do it so often, you know what to look for and you know what's good in a property, what's not good in a property. And people can build with confidence, right? And yes, it may cost a little bit of money to bring on a buyer's agent, but if that means their portfolio grows better or is more sustainable in the long term, then it's definitely worth it. If it unlocks that next level of wealth for that person.
Yeah, without trying to promote my services too much, like there's a few reasons why people use a buyer's agent. For
Yeah,
commercial, I definitely encourage it if you don't know what you're doing because like the information's out there. You know, I'm very giving with my information. You can download my due diligence checklist. I've got 350-page book. I've got I think about 20 episode podcast now. I've got oh, probably about 50 hours plus of YouTube educational videos. Like you can go do it yourself. But like
yes,
you said, I'll protect you from making those little mistakes here and there. The other benefit is obviously hopefully get you a better price than you'll get yourself, because I do this all day, every day, and have some good relationships with agents. I'll get off market and I'll save my fee there. But I'm not
Mhm.
saying you can't do it yourself. I've never used a buyer's agent. I've always done it myself. So you can go do it yourself. But just be aware, each deal you're talking minimum 20 to 40 hours worth of due diligence. So it's not something you just casually do. So we also save you a lot of time, like the time doing the due diligence and then ignoring that, just looking for properties. Like on average, we're going to spend about 100 to 200 hours per client looking for a property. So you can do that, but you're going to lose every weeknight for the next 6 months of your life.
Yeah, and not just that. That's 20 to 40 hours for you, for your guys who are professionals that know what they're doing. For somebody
Yeah,
that
that's
doesn't
a
know
good
what
point.
they're doing, it's probably like 100, 200 hours minimum just in due diligence, which is nuts.
Yeah.
Um, yeah, fantastic. So,
Yeah, good point. Actually, I've got a qualified valuer doing it.
yes, yeah, which I think makes it a lot better too. It's a lot. People can have a lot more confidence in that rather than their own guesstimates, which is good. Fantastic. So, wrapping up, is there any final pieces of knowledge that you'd like to share with the listeners?
Main thing is just get educated. There's a lot of moving parts, and like my general rule of thumb, and like the advice I tell people in this industry is, don't trust anyone with your well-being, your financial well-being. Like no one cares as much as you do about your own financial well-being. Don't even trust me, like because like if anyone's getting an incentive from like getting paid to do a service, they want to get a deal done. But I know
Yes.
that when they give you information, it's going to stack up. So but if you can understand what's going on, you're less likely to have the wool pulled over your eyes. So just get educated. If you want a free copy of my book, go to the website and download a free copy of the book, or send you a hard copy. Just use the free book at checkout. Yeah, all my stuff is freely available, so you don't have to pay for anything.
Yeah, that's amazing. Awesome. And your website is paliseproperty.com.au, is that correct?
No.au. That's how good
Oh,
I am. I'm international. I'm not, but it's just.com.
yeah, fantastic, fantastic. Awesome, Maurice. Well, thanks for coming on the podcast, Steve. It was great to have you. I think there's some great info in there for our listeners, and we'll catch up again for another one to chat a bit more resi next time.
Legend, mate. Thanks for having me on.
No worries. Thanks, Steve.